Hello and welcome to our webinar series on the topic of climate change. This second webinar is entitled Using Carbon Intensity for Portfolio Management, Why Denominators Matter, and will discuss carbon metrics for portfolio construction and reporting. It will be hosted by Frédéric Ducoulombier, ESG Director at Scientific Beta, who will be joined by Eric Christensen, ESG and Low Carbon Solutions Specialist at Scientific Beta, and Victor Liu, ESG Analyst at Scientific Beta. If you have a question on the topic, you can use either the Q&A function or the raise hand sign at the bottom of your screen. We will address the questions at the end of the presentation. Thank you. So Frédéric, the floor is yours. Thank you.
Thank you, Séverine. Thank you all for participating in this seminar. The topic today, as Séverine mentioned, is the question of the denominators in the formula for carbon intensity. It sounds pretty specific, but we will see that it's really important for impact. What has motivated our research in the topic and what motivates this presentation? As you are probably aware, there has been an update in the benchmark regulation in the European Union in December that detailed the standards for the so-called EU climate transition benchmarks and Paris-aligned benchmark. These new benchmark labels and new index labels aim to steer the investment flows towards greener investments with a view to promoting sustainability in the real world. And the standards are also meant to help transparency in the low carbon index market, and especially combat greenwashing, so misleading allegations about the greenness of your product. The Act approaches decarbonization through weighted average carbon intensity, which is a well-known and often used metric for low carbon portfolios, but it does change the denominator in the formula. Instead of dividing emissions by revenues, as was the standard, it uses enterprise value. So it sounds pretty second order, but as we shall see, it has an impact. And here we will review the justification for the change of metric that was given by the European Commission, look at the consequences in terms of transparency of the market and the promotion of sustainability, and offer advice to investors who are concerned about impact. The key findings of our investigation is that while just the substitution of denominator was justified by the impact it would have on sectors that are especially at risk of stranding, the impact goes way beyond. There are winners and losers from this switch in denominator, and the winners and losers have very little to do with the climate performance of the sectors affected. So that's the first point. The second point is that the metric was presented as being applicable to both equity and corporate fixed income, as the standard metric is, but in fact it cannot be computed when you don't have market capitalization of equity and you fall back on a second measure. So in fact, you had a standard measure that was applicable across both equity and fixed income, and with the switch, you need to use a different measure for certain fixed income portfolios. So you are hurting the comparability and therefore the transparency. But last and not least, the substitution injects considerable capital market volatility in the measurement of carbon intensity. So the link between emissions and carbon intensity is weakened, and that the risk is that you end up rewarding a company for its stock market performance as opposed to its decarbonization performance when you build a portfolio according to this new definition of carbon intensity. And obviously that is pretty counterproductive if you are targeting impact. So the conclusion is that it may make complete sense to use enterprise value for normalizing, let's say, emissions if you need to report at the portfolio level, but you should not let it drive your portfolio construction if you care about impact. So these are the key findings. Now I'm going to take you over these individually, starting with considerations on carbon intensity and carbon metrics. It's no longer outlandish to explain that there's an urgent need for carbon intensity reduction. We know that to have a chance to limit the global warming below 1.5 degrees above pre-industrial temperatures, the need for contraction in emission is considerable. Since not much has happened in the last 10 years, the latest science suggests that you need to reduce emissions almost by 8% over the next decade to limit global warming and achieve net zero emissions by mid-century. So that obviously presupposes that you have very significant reductions in the carbon intensity of activities. Carbon intensity being the amount of emissions divided by the output. Changes in carbon intensity, primarily powered by reduction of intensity of electricity and massive electrification of the economy to replace fossil fuels, and changes in terms of consumption patterns will also be required to achieve this net zero objective. So when you compute carbon intensity, you may want to relate the emissions to the physical output of the process. And obviously, if you have outputs and processes that are very comparable, it makes a lot of sense if you can get your hands on the data. But as soon as you start comparing things that are only similar without being identical, it becomes difficult. And if you compare products that may be substitutable but are of a different nature, then you can no longer use physical quantities to compute carbon intensity. And there, measuring output by monetary units will allow you to compare carbon intensities when you don't have access to physical quantities, or when they are not so relevant, as in the products are different. And if you use carbon intensities relative to monetary units, you will also be able to compute averages of intensities across your portfolio if you're an investor. When using a monetary units, it does appear sensible to relate the emissions to the market value of the products or services that they are used to produce. The use of a proxy of market value revenues is beneficial when you compare it to other possible metrics like value added, which may turn negative. You don't have this problem so often with sales or revenues, so it's easier to get a sensible metric by relating emissions to revenue. So now I'm going to go over a few popular carbon metrics based on emissions. One thing I need to explain first is that there is a difference between carbon footprinting metrics and carbon exposure metrics. The carbon footprinting metric tries to allocate the responsibility for the emissions And it does so by looking at the polluting assets, the polluting companies, for example, and allocating the responsibility for the pollution based on the share of the company that you control. And typically, in the context of the greenhouse gas protocol, this is based on the equity share. So, for example, total emissions for a portfolio gives you the measure of the absolute emissions associated with the portfolio. And as the formula here shows, it's just the sum of the share of companies you own times the emissions of the company. This is very useful to measure the overall emissions associated with your portfolio. Now, the portfolio may change in size over time, and you may want to control for size. So it's very common to express this relative to the size of the portfolio, the market value of the portfolio, and this is called carbon footprint. Another carbon footprinting metric that has been used relates the emissions that you have financed with your equity investments relative to the revenues that they have generated. The formula is a bit more involved, and that's one of the reasons why it's not so used, not so popular. So these three metrics, total emissions, carbon footprint, and carbon intensity, are footprinting metrics. The concern is to allocate the responsibility for the emissions to an investor. The key for allocation is the equity, but you may want to extend this to take into account debt financing. And if you do so, then very much you'll be getting as a denominator enterprise value if you compute total emissions or carbon footprint. These are carbon footprinting metrics. The other type of metric is an exposure metric. It just tries to give you an idea of your exposure to carbon intensive companies. So you could be measuring the weights of companies from sectors that are carbon intensive, or if you want to use the emissions, you could average the intensities of the companies in your portfolio. So that's what is done here with weighted average carbon intensity. It's just the weighted average of the intensities of each company. So it doesn't matter how much of the company you control. That's not the purpose there. The idea is that you get a proxy of your exposure to carbon intensive activities. So these are the traditional metrics, and this list is taken from the work of the task force on climate-related financial disclosures that was established by the FSB in 2017. In relation to these metrics, the task force recommended for reporting by asset owners and managers the use of weighted average carbon intensity because it can be applied across asset classes, as I mentioned before, and is fairly simple to calculate. You just need the weights of the portfolio and the intensity of the constituents of your portfolio. And it's not that sensitive to share price movements, unlike metrics that use market capitalization to compute intensity per unit per dollar invested. Now, since weighted average carbon intensity is not a carbon footprint, some investors and some investor coalitions recommend reporting total emissions and also carbon footprint, so the emissions divided by the size of the portfolio. And for those investors that own debts, it's often recommended that they compute the enterprise value extension of carbon footprint. So when you report based on carbon footprint extended to enterprise value, carbon footprint measured by allocating responsibility across equity and debt. It may be very tempting to build your portfolio using a metric that also relates emissions to enterprise value. But this is not how the European Commission has justified the changes of denominator in carbon intensity. But that could be a justification. We'll see that it comes with issues. The way carbon intensity is used in the benchmark regulation is as follows. There is the requirement for these indices that will be labeled EU climate benchmarks to reduce weighted average carbon intensity at the index level by relative to the overall universe by 30 or 50% depending on the index. And this is an approach that has long been a mainstay of low carbon indices, and that you can justify both from an impact or a carbon risk exposure perspective. So that's the first decarbonization. You decarbonize relative to the universe, relative to the cap-weighted index of the universe, and you cut the average intensity by 30 or 50%. The second type of decarbonization is a year-on-year reduction in the weighted average carbon intensity of your index. And that is something that was quite innovative and interesting, and whose objective is to force emissions related to the portfolio to contract year after year, and to put the index on a decarbonization pathway. Last but not least, the regulation also puts a constraints on what you can do in your index with companies that have defined science-based targets for future decarbonization. For greenwashing control reasons, the regulator has found it interesting to forbid index administrators to increase exposure to these companies unless they have achieved a 7% reduction in carbon intensity over the last 3 years. So these are the references to carbon intensity in the regulation. Now, like I mentioned, the traditional approach to carbon intensity was relating emissions to revenues, and the regulator has substituted enterprise value for revenues. What was the purpose, and how was this defended? The advisors of the Commission acknowledged that revenues were relevant denominator for assessing the decarbonization of companies within sectors, but they explained that it would be so much better to shift to enterprise value because this would hurt those sectors like coal that were exposed to risks of seeing assets stranded by the transition to low carbon economy. And since these risks exist and are recognized, the asset prices are depressed, and because asset prices are depressed, enterprise value is depressed. So if you divide by enterprise value, you get a higher carbon intensity for these assets, and therefore when you decarbonize, they will be hit first. And upholding the standard was presented as greenwashing. Now, subsidizing coal divestment when it's already widely practiced can be seen as reducing the decarbonization ambitions of your index. I doubt investors need a regulatory boost for getting rid of coal in their portfolios, and if they need one, maybe doing it directly rather than through a change of metric would be relevant. as obviously when you use enterprise value, you advantage companies that have higher profitability, higher growth, or lower risk. This because the capitalization of these companies will be higher than other companies' capitalization, all things equal. So by changing the metric to target coal and other sectors exposed to stranding risk, you have unintended consequences in respect of other sectors, which are not related to the climate relevance or performance, but simply to profitability, growth, and risk. And I will show you some charts on this. Second, the shift to enterprise value will be reducing the link to, and you can justify that in the absence of growth and risk, enterprise value is a good proxy of current added value. It just capitalizes current added value. So you're comparing a flow variable revenues to a stock variable capitalized, like enterprise value with capitalization of revenue of value added. But the relationship is quite straightforward. However, in realistic market circumstances, the enterprise value becomes a very noisy proxy of the current value added by the company, and that is linked to, or could be linked to current emissions. And this weakening of the link is an issue. So this shows an example where we look at the emissions in blue and look at the carbon intensity computed with revenues in red, and the carbon intensity computed with the enterprise value in green. And what we see here is that due to very buoyant stock market performance, the intensity measures relative to the intensity expressed with EVIC, enterprise value, does fall over time when the emissions fall far less rapidly. And while you have pretty good correlations with revenue here, the link between emissions and enterprise value is not obvious, and this gives you the wrong picture about the intensity. This is the list of sectors that suffer when you shift the denominator from revenues to enterprise value. So these are the sectors that poorly capitalize sales, if you want. So obviously, to the extreme left there, we see coal and related energy. These are this is close to the worst affected sector. That is true, but you also see that traditional retailers, construction industry, electronics, telecom also lose out. And look at the scale here. The average is about 3 in the market. Now I'm going to show you the winners, and you see that the scale is very different. It goes up to 30. The winners are these sectors: online retailing, utilities, healthcare, software companies, renewables, financial services, etc. So some of these could be seen as greener, so the switch benefits some green companies, and some of them not so green after all. And the same was true when you looked at the losers. So you shifted the metric, you created winners and losers relative to the current metric, but this has nothing to do with climate change, and that's an issue. Second issue is the impact on transparency. As I mentioned before, if you compute, you need enterprise value to compute your carbon intensity. What do you do when you don't have a market capitalization? You can't compute enterprise value. So the Commission's advisors suggested that you use book values, but this would have favored listed companies over unlisted companies, as typically market cap is richer than book value. This would also have created geographic biases and sectoral distortions based on the access to the market in different countries and based on difference in multiples across sectors. So the European Commission did not follow the advice of the work group that prepared the standards, and instead it allowed the use of absolute emissions for debt securities um, and imposed the use of absolute emissions for debt securities of unlisted companies. So because of this issue affecting the computation of enterprise value, the metric that you are supposed to compute, build your portfolio with, and report are different depending on whether you are looking at an equity investment, a listed debt investment, or an unlisted debt investment. And across that, you have some measure of flexibility given to the advisor in respect of the metric that it can choose. So in the end, you have several indicators where previously you had one indicator that was working across asset classes. So you would have maintained consistency by sticking to the market standard. So no progress there in terms of transparency. But the worst part of the story is the fluctuations, the volatility that you introduce in carbon intensity measurement when you use enterprise value. And interestingly, this is something that was initially been pointed out by the advisors of the Commission. The very first report by the technical expert group on sustainable finance that advised the Commission, the work group noted that the market effects could create misleading results and explained that, when market values rise, you will see possibly a very significant lowering of intensity without any required change in emissions. So this was considered very bad, and as a result, initially, those indicators that were using market values were rejected by the advisors. But the proposals they made were even more flawed, and this was pointed out in the call for feedback, and this led to a revision of the views in indicators of the technical expert group. So in the end, the carbon intensity metric used by the Act is emissions related to enterprise value, and to correct the fluctuation of market prices that creates this risk of misleading results. The Act has provided for an adjustment on each measured carbon intensity that adjusts by the average change across all companies. Now, this reduces the volatility, yes, but it does it on the base of the average change, and this leaves an advantage for the sectors and companies that have a favorable market momentum, because their enterprise value will have increased significantly, and even if you divide by the average change in the market, they are still favored. There are some other issues with the use of enterprise value. The Act references the end of the fiscal year to compute the value, and of course, different companies have different fiscal year ends, and the market conditions will be very different at different times in the year. But since you use fiscal year end, you have to take them at that time. So a company may be advantage or disadvantage based on its fiscal year. Of course, this is quite random from one year to another, but this introduces noise as well. So as a result, the benchmark composition over the years, when you try to control the average intensity in your portfolio, may be decided primarily by the momentum in the price of companies, as opposed to the progress in terms of emission. This is meant to give you an idea of the problem. What we did here is we took the last 7 years of emissions data across our developed universe, and we computed carbon intensities using revenues or using EVOC, enterprise value including cash, which is the metric used for by the regulation. And we look at the year-on-year changes across all the companies in the universe. So you see them as a distribution, and what you see clearly is that there is a spike in the middle for carbon to revenues. The density of carbon to revenues is much more at the center than it is for carbon to enterprise value. So more than a fourth of the yearly changes in intensity, if you measure by revenues, are within 5% difference year on year. So the change in carbon intensity when you measure against revenues is 1/4 of the time within plus or minus 5%. But if you measure relative to enterprise value, it's only a sixth of the companies that are in narrowly around 0, plus 5% or minus 5%. So, and you see there's also more extreme values for carbon intensity when measured by relative to enterprise value. So the intensity metric will be more volatile when expressed with enterprise value than we express with revenues. And if you build your portfolio you choose your portfolio based on carbon intensity to achieve your portfolio level reductions of 50% or your portfolio level reduction of 7% per annum, well, you'll be favoring those companies that have had good performance, good evolution in terms of intensity, that reduce their intensity. And this may be for the wrong reasons, i.e. Because of price momentum as opposed to, well, performance in emissions. So what we did to give further color to the issue was to look at how many of the companies that show 7% reduction in carbon intensity have 7% reduction in emissions or more. Why 7%? Again, because that's what the Act requires you to contract the weighted average carbon intensity of the portfolio year after year. So with enterprise value, including cash, only 45% of the companies that have 7% or more reduction in intensity have 7% or more reduction in emissions. And a whole 30% of companies with 7% reduction in intensity don't show any reduction in emissions. On the contrary, they show an increase in emissions. If you look at the figures for revenue, 60% of those companies that have intensity that are reduced by 7% or more also have emissions that are reduced by 60% or more, by 7% or more, sorry, and only 18% of the companies with 7% or more reduction in intensity have emissions that increase. So it's a much better picture, and you should also remember that with carbon intensity measured relative to revenues, you can make a satisfying case that the efficiency of the company, the efficiency of the process has increased. You have generated more revenues with the same amount of carbon. It's much harder to make the same case if you're using a financial variable like enterprise value. So what can we do with that? In general, we recommend that investors that wish to encourage change in the real economy at the corporate level should look at how their indices are constructed and look at whether the metric that are used makes sense for index construction to drive the selection of securities or the weighting of securities in the index. And the question should be, can the portfolio construction, and here specifically, can the metric that is used to choose companies or to weight companies, can it promote and reward climate action, progress in terms of emissions at the level of the companies? As we've seen, it may be fine to use enterprise value, including cash-based carbon footprints, to look at the responsibility that you have as a financer of companies for the emissions of these companies. But if you use a version of carbon intensity that is using enterprise value rather than revenues, you will be selecting stocks largely based on their stock market performance with limited relationship to the emissions. So make sure that the stocks are chosen or weighted primarily using metrics that are much better associated with emissions than what you get with carbon intensity expressed relative to enterprise value. Now, if you're going for a EU climate benchmark, you still need to achieve this 50% reduction in weighted average carbon intensity measured using enterprise value. So even if you use the right metric to build the portfolio, there may be the need for an adjustment to respect the Act standards for compliance. But this could be just an adjustment at the end, and this need not pollute the selection of stocks or the relative weights between stocks or the signals that you are sending to companies. And it'd be useful when you look at metrics using the construction of the portfolio to try and find metrics that are testament to a company's being aligned with a decarbonization pathway that makes sense for it relative to its sector. Now, this is particularly challenging under the benchmark regulation because companies that publish science-based targets that have demonstrated that their decarbonization objectives were consistent with science and consistent with the Paris Agreement objectives. These companies can only be rewarded through overweighting in the Act when their carbon intensity measured relative to EVIC has fallen by 7% over the last 3 years. So there may not be so many companies that have such targets, but whatever companies have these targets still need to pass this backward-looking test that is affected by price momentum. So as much as you would like to reward those companies, the Act use of enterprise value for greenwashing control makes it difficult. So that's all for my presentation. We are open to questions. Evan, you want to take it from me here?
Yes, thank you very much, Frédéric. We already have received a few questions through the interface. So the first question is if an investor invests in both equity and corporate bonds of the same company, would you proportionally allocate finance total emissions to the two segments or use total emissions in both cases?
Okay. Eric, you want to?
Yeah, so you would use total emissions in both cases. You basically take all the emissions and you divide by all the capital being the equity capital and the bond capital. And then if the same investor has two different portfolios, well, you get a part of the, let's say, the carbon footprint or carbon intensity in this case through the bond portfolio and part of it through the equity portfolio. But to answer the question, yes, you take the total emissions and you divide it by the total capital being bonds plus equity.
Thank you, Eric. Another question is it not the case that enterprise value is a correct denominator in a fundamental way? For example, if you buy all stocks and bonds of a company, that investment makes your portfolio accountable for exactly 100% of the absolute GHG emissions of that company, if enterprise value is used as a denominator. This is not the case for other denominators.
Yes, so indeed, using carbon intensity by dividing by enterprise value is a correct measure of a carbon footprint, i.e. a measure of each investor's contribution or responsibility for total emissions. So there's nothing wrong with using EVIC as a footprinting measure. What we are saying is that when you want to use a measure for portfolio construction where you need to send a signal to companies for them to actually change the way they behave and the way they invest in environmentally friendly technologies, for example. If you want to send a clear signal to companies to give them a strong incentive, you need to use a metric that has a strong link to their activity, to their actual economic output. And in that case, using revenues is a better proxy for a company's output than its enterprise value, which is very tied to stock market fluctuations over which the company management has much less control, at least in the short term. So yes, using enterprise value is a measure. It's a good, correct measure if you want to have a corporate or a carbon footprint measure. But if you want to use a metric for portfolio construction where you want to give companies a clear incentive to decarbonize, you should use another proxy, in particular revenues, which has a stronger link to the company's actual economic outputs. That was our message here.
Thank you, Eric. Sorry.
Yes, Severin, I see there's a question on the inflation adjustment of the enterprise value.
Mm-hmm.
That's something I did not underline in my presentation. Let me try to beam it to you again. Zoom. Severin, can you show your presentation? I'm looking for slide 16.
This one?
Yeah, this one.
Oh.
So the question is, the regulation importantly advised the inflation adjustment of enterprise value, which offsets a lot of the noise when reporting the index level carbon intensity in the benchmark. How many of your concerns does inflation adjustment address? Okay, we engaged the advisors of the Commission in the middle of, at the beginning of 2020 on this issue at a time when the inflation adjustment was only one unidirectional, only one-sided. And we explained that this was very dangerous because you may also have a situation when falling prices would send your carbon intensity relative to enterprise value soaring. And it may be that we were heard, it may be that the aftermath of the triggering of COVID-19, of the COVID-19 pandemic, showed the impact that falling prices had on carbon intensities measured to enterprise value that were not adjusted for deflation. In the end, the European Commission made the adjustment for changes in enterprise value bi-directional. So whether the prices go up or down, you adjust by the average level of prices to make sure that the 7% to try and give your 7% stability in terms of real emissions contraction. Well, the figures I showed you had already been corrected for inflation. So I wanted to make it easier and not discuss this point. So I took the most favorable view of the problem, and these 45% of companies that appear well, that have a falling carbon intensity, but in fact see their emissions increase. This is after we have applied the correction for inflation. So the correction for inflation, now that it's bilateral, makes it less likely that the constraints put forward by the Commission would be impossible to follow or would cause major shifts in the portfolio. That is true, but the rescaling by the average change in enterprise value still leaves the question of those companies and sectors that are advantaged because their price momentum is positive, and you still see here this issue of very weak link between emissions progress and carbon intensity progress.
Thank you, Frédéric. We have another question. Is AVIC-based carbon intensity more volatile than the revenue-based intensity in all sectors?
Okay, I think I can take this one. So in the context of our study, which is developed markets and looking at data from 2013 to 2020, we measured volatility with year-on-year changes in carbon intensity. And what we observed is that using EV, we have consistently higher dispersion for carbon intensities, and that is robust when we look within macroeconomic sectors. We have had discussions with investors that justified EV-based carbon intensities with expected better stability for issuers involved in commodity businesses, but in our data, energy and basic materials are well within the average of economic sectors. So we haven't seen any evidence of that.
Okay, there's a question, Séverine, on that goes, how do you link reduction in carbon intensity to reduction in real-world emissions and net zero pathways? This is one of the requirements of the Net Zero Asset Owner Alliance. Yes, indeed, when you use carbon intensity, there's always the risk that carbon emissions continue to rise. At the same time, when you use total emissions, there is the risk that any fall you see is explainable, can be explained away by changes in the allocation within your portfolio. You reduce the amount of highly carbon intensive companies in your portfolio, and that reduces your total emissions, and you think you've done something good, but maybe not that much. So the Net Zero Asset Owner Alliance suggests that you use both total emissions at the level of your portfolio and carbon intensity to make sure that when you see a fall in total emission, it is coming from a fall in carbon intensity and not another type of change in the portfolio. Now, changes in carbon intensity could also be coming from reallocation. So there you would have to control the exposure to the different sectors to make sure that what you are seeing is improvement within a sector as opposed to reallocation of funds across sectors. So this is fully controlled by the BMR regulation, as the control of the sectors is done over macro sectors that include a dozen medium and high carbon intensity sectors. So you can reallocate as much as you want within the sectors and still meet the requirements of the regulation. So that's not a guarantee. Yeah, when looking at weighted average carbon intensity gains of the portfolio, you should control for your sector exposures to make sure that you are seeing the right kind of change. And obviously, you should also look at what's happening within the sector and whether the changes that you are seeing are suggestive of better alignment in the sector, and how much of the changes are coming from actual progress by company versus changes in the composition of the portfolio.
Thank you, Frédéric. I think we have time for another couple of questions. How are carbon offsets considered within the carbon intensity measure?
Okay, as far as we are concerned, we do not take into account carbon offsets. The closest thing that comes to carbon offsets is the way the electricity is accounted for. When the company reports emissions, it can be done based on the average intensity of electricity in the market for its Scope 2 emissions, or it can be done based on the electricity that it has purchased if it has an instrument that links its purchase of electricity to certain sources of electricity. So it's possible for companies to ensure that their electricity is sourced from clean sources, and they are allowed to use this intensity of electricity in their Scope 2 reporting. So that's we don't take into account offsets for carbon intensity, but you still have this mechanism for companies that go for green energy, and they are rewarded by being allowed to report Scope 2 based on their purchases as opposed to the market average, and this will show in the figures.
Thank you, Frédéric. We have time for last question. How would you approach the calculation of a single CO2 metric for a portfolio that contains both government and corporate bonds?
That's probably a $1,000 question.
I don't think there's a very good answer to that. I don't know. I don't think there's a very good, easy answer to that. Maybe I just wanted to add one thing about the question about carbon offsets, because what you can call offsets, there can have different definitions. So, for example, you could call a company that simply buys, let's say, emission certificates, for example, you could call that an offset. That has been heavily criticized by organizations such as IGCC as being sort of a greenwashing, because basically buying these certificates would not necessarily translate into any real world emissions reductions. So that would clearly not be something that was even, let's say, ideal. Even if you had all the data, etc., about these types of offsets, it would not be something that would contribute to climate change. Other offsets could be, let's say, carbon storage, and that would maybe be a sort of valid kind of an offset that you might want to take into account. And then there are a third kind of offsets, which you would call, let's say, carbon avoidance. So let's say coming up with a new technology that is more efficient and sort of avoids emissions relative to what a normal current technology would be. And that I think Frederick touched upon that subject. It's a difficult subject from a methodological point of view to be objective in the way you define avoided emissions. Could also lead to greenwashing, because you could have some very, let's say, optimistic assumptions about avoided emissions, and therefore using carbon offset data that was not really reflective of real emissions reductions. So depending on how you define offsets, whether it's buying carbon emissions certificates, whether it's carbon capture, or whether it's carbon avoidance technologies, the answer is quite different.
And clearly most coalitions advise against mixing these different types of emissions together, especially counting avoided emissions as a negative relative to actual emissions. That's not something that I've seen a lot of support for. There's one more question that I can take, Séverine. Here, would the use of only green debt in the enterprise value calculation change your opinion on the new intensity metric? So our issue with the metric is not that the debt is green or non-green. It's not that it doesn't make sense to allocate responsibility across equity and debt. You could discuss what is the responsibility of a stockholder versus a bondholder, but at the same time, you can say that a lot of the change happens because of refinancing on the bond market. So it makes sense to try and incentivize investors to act based on their debt investments. So we don't have a problem with enterprise value as used for footprinting. It does make sense, and it is promoting action by both equity holders and bondholders, and that is good. What we object to is to use it as a portfolio construction target, a hard target that incentivizes index administrator to use it for asset selection in the portfolio, which leads to making decisions that are based on price momentum and not decarbonization performance. And that is avoidable, and that should be avoided.
Thank you very much, Frédéric. There are still a few questions, but we are running out of time, so we will be answering to those by email. We will be sending the materials and recording to all the participants after this webinar very shortly. And of course, we remain at your disposal for any follow-up questions you may have. Please feel free to contact us at the email address webinar@scientificbeta.com. Thank you all, and goodbye.